Good morning, everyone. Thank you very much for joining me. This is the morning market review. My name is Russell. I'm a senior market specialist at FXCM. My email address is r@fxcm.com. Today is Wednesday. It's the 31st of August. Just going to bring up our high risk investment warning. We'll go for roughly 17 minutes. Then we'll switch over to the crypto minute. It is Wednesday. I just want to give you the heads up there. We also got the live trade, the NFP trade on Friday. So I've pasted that link into the chat. So please register through that link if it's something that you'd like to join us for. Open invitation, of course. If you have any issues with registration, you can certainly just send me an email and I will I'll get everything sorted out. Let's just bring up market commentaries disclaimer as well. Good morning, Howard. Nice to have you on the webinar. Thank you very much for joining. Thank you to everyone for joining this morning. All right, references, MarketScope 2.0. We're going to do CNBC, just the morning article very quickly. We'll also consider TradingView, which I'll just put up here. And what we can do, what I was thinking we'll do this morning is perhaps just carry on with that discussion we started yesterday in terms of is it worth going contrarian? It's an open question. I mean, I'd very much like to hear your guys' as comments. And Chris sent me a very interesting article from CNBC, which I shared with you guys yesterday. Since then, I've listened to a lot of pundits and market analysts on Bloomberg. It's just completely negative out there, completely bearish. So if you've got any comments, you can type those in, and I'm very happy to share that with everyone on the webinar. In the meantime, I'm going to just go through the CNBC article. European markets head for higher open, bucking negative global trend. European markets are heading for a higher open on Wednesday, bucking a more negative trend in Asia Pacific market overnight. And after Wall Street's losing streak stretched into a third day, market jitters have been evident since Friday after hawkish remarks from Federal Reserve Chair Jerome Powell. On Tuesday, New York Fed President John Williams called for a somewhat restrictive policy to slow demand. Shares in the Asia Pacific fell in Wednesday trade following a negative lead from Wall Street, and as investors digest China's factory activity data. Meanwhile, US stock futures were flat in overnight trading. It's interesting, the CNBC article has shortened considerably. I can't find the articles that we that we used to reference just a few weeks back. They've kind of changed their format. So I might see if there is other sort of more detailed type of news, morning news items that we can read. I think this is a little bit lacking compared to what it used to divulge, so to speak. All right. So just before we get into this, talking about contrarian, again, I'm going to suggest that we start having this conversation. I'm not going to suggest that we become contrarians. That's not what I'm suggesting. But I think it's worth having this discussion in terms of, is it worth becoming contrarian, or how shall we approach that? And I'll give you my thinking in a moment, and then obviously go ahead and give me your thoughts. But let's just take a look back at the real rate. So this has become sort of the backbone or the linchpin or the cornerstone of really the analysis. How are real rates behaving? And they are bullish. I don't think that we can suggest otherwise. They've moved into the bullish zone between the red and the upper blue. And just something that is worth pointing out, because I think it is important, is that the Bollinger Bands are narrowing. And the reason I think that it's important is because we had a very obvious message on Friday that you know, the Fed's fighting inflation. That was their message. And of course, if there is a contraction in the, or a squeeze in the Bollingers, it's usually a precursor to some sort of volatility. And one may suggest that given the hawkishness that we heard on Friday, that perhaps there's going to be an expansion in volatility to the upside. So it remains to be seen. We'll have to see if that is the breakout, if there is a breakout in that direction. And the technicals would kind of be suggesting that is a distinct possibility. And of course, when we take a look at the US dollar, the US dollar is in the bullish area as well, isn't it? It's in the zone between the upper blue and the upper red. That's what we call zone 1. And of course, the longer it stays in zone 1, well, the higher the probability of price appreciation. So we've got the real rates that are supportive, and we've got the dollar which is reacting to the supportive rates. However, I'm of the opinion that the rates themselves are not behaving quite how I expected them. I mean, when I listened to the delivery on Friday, I was after I finished it again. It was very short, 9 minutes, right? Once it was complete, I was thinking, wow, the market is going to, the rates are going to skyrocket. That was going through my mind, but that's not what's happened. In fact, if we go down to the daily, the reactions have been very ordinary. Yesterday, we've got a doji, so the real rates are just uncertain. We've got bulls taking the real rates up. Let's call them hawks taking rates up, doves taking rates down, and we close completely flat. And we've got a slightly red day today. So the reaction here, certainly not what I was expecting. Hey Anna, no worries, welcome, and thank you very much for joining. We're going to jump through in 10 minutes. We'll jump through to the crypto just as a heads up, and then in the chat you'll find the link to the live trade if you want to join. No, you haven't missed much. We're just going through very much what we suggested yesterday, in that I would have expected higher rates, but the market movements have been quite odd, in my opinion, quite odd. And the reason why I think it's worth keeping an eye on this is because the question comes up, shall we start discussing potential bottoms? Now, this is a huge question to ask, because everybody is bearish out there. So it's not a comfortable position to be different, right? It's really not a comfortable position, especially when there is such strong negative sentiment. But that in of itself does have a kind of appeal, you know, like, well, we're not following the crowd. Perhaps there is an opportunity here. Now, again, I've got to stress, okay, that I'm not suggesting we go all in contrarian, because that's potentially financial suicide if the market moves down. I'm saying that we've got to be very measured in our approach. Yeah, and of course, just to reiterate, the squeeze in the bands here, does that mean that there is going to be a movement up in the rates? Because of course, if there is an expansion in volatility in terms of real rates and the move upwards, then of course the contrarian scenario goes out of the window. Then we'll have to be talking about high rates. And the question is, well, why will the scenario go out of the window? And that brings me to very much the next point, which I think is why we can start talking about contrarian, and why we can discount contrarian if the rates move up. So let's just explore that further. And it's going to come back to the time value of money. I know it's a sort of a mathematical function, but there's really no way we can get away from it. And I've tried to make it as simple as possible. So if there's any confusion here, you must let me know, and we must work through it, because I think that if we just can understand this function, we're going to keep it very, very simple. There's no, we're not doing any complex discounting of cash flows, nothing like that. All we're doing is we're looking at a high school mathematical equation, and it simply goes present value equals future value. Okay, sorry, I've got this all backwards. Bear with me a moment. I'm talking about high school maths, and I'm writing the function incorrectly. Okay, so the function is future value equals, okay, present value times, because the little times 1 plus interest. Okay, and then the truth is there is an exponent. There is an exponent in this, and the exponent's, I think, just going to complicate the situation. So we're going to just take it out completely. Not even going to look at the exponents. We don't really need it to, I think, have a decent conversation here. And the idea is we're going to make a substitution for future value, okay? And we're going to rearrange. We're going to start rearranging this formula. So what we're going to do is future value. We're going to just introduce. We're just going to introduce something called dividends or interest. Let's just call it cash flows. Okay. And we're going to assume cash flows is a constant. Okay. So we're making an assumption. It's not a realistic assumption, but it's going to help us in terms of our reasoning. So cash flow is a constant. So you can just think about it. If you buy a company, you're going to receive $10 in dividends for infinity. Okay, it's a constant. That's what we say. And we're going to rearrange it as follows. So we're going to say present value equals cash flow, which we've substituted instead of future value. Okay, if you're asking how does that fit in, you can write it as future value. And then what we're going to do is we're going to put all of this over 1 plus interest. And this is the function we're working with. We're not going to do any more massaging of variables. All we've done is we have taken this 1 plus interest and we've moved it across. That's really what we've done, and we've just changed the name of that future value to cash flow. Now, this actually makes things very interesting for us in terms of coming out with a sensible discussion, because everything now is going to revolve around this guy. Everything's going to revolve around this guy, okay, in terms of our discussion. So the question is, are interest rates moving up or are interest rates moving down? That's the key, okay? So this is the key question. Are interest rates going up or down? Now, according to what we spoke about on Friday, they should be skyrocketing. Well, not what we talked about, what we heard out of Jackson Hole. They should be skyrocketing. They should be skyrocketing. So if they are skyrocketing, okay, then the denominator moves up. And what tends to happen when the denominator moves up is the present value should move down. Okay, let's just understand that. If there's any confusion, you must let me know. You must let me know if there's any confusion. But we'll just put it as follows. I'm going to make it very, very simple. The cash flow, remember, we've assumed as a constant, and we're going to put the interest rate here, okay, as 1, let's say 1 plus 1, which is 2. Let's call it 2. And then if I had to say, well, okay, we've got a cash flow of 1, we've got a 1 plus interest of 2, well, what's the present value? I think all of you will say, well, that's very easy to calculate. It's 0.5, okay? And then if after Jackson Hole, interest rate moves from 1 to 3, so we get 1 plus 3, then we would get sort of a function where it gets 1 divided by 4. And if I say, okay, if your cash flow is 1 and now the 1 plus interest has adjusted to 4, what's our present value? I think all of us would say, that's okay, we can see it's 0.25. So in other words, as the interest rate moves up, present value comes down. That's the key, okay? As interest rate moves up, present value moves down. That's what we're getting at here. So what happens if this interest rate has now been fully discounted? In other words, all the bullishness, all the hawkishness, not the bullishness, all the hawkishness that that was referred to, all the hawkishness. What happens if that's all reflected in this number 4? What happens if it's all reflected in this number 4? In other words, we've been here for quite some time. Okay, so then if we've been here for quite some time, then there's going to be not that much sort of change up or volatility to this guy here. So we might get some deviations, and we will get deviations around 4, okay, and we'll get slight deviations around the 0.25. But by and large, we kind of, let's assume that this 4 is kind of maxing out. Then this 0.25 is making some sort of bottom. Well, if it's making some sort of bottom, wouldn't that be sort of the contrarian? Wouldn't that be the contrarian argument right there? So I'm just cognizant of time. We'll continue this sort of in the next webinar, but just before we go, and that's why we watch this guy here. This is where the mechanism, the adjustment's going to take place, right here. Okay, so let's keep an eye on interest rates, because we're using the real rate here to see what happens. Now, the whole point is that the real rate hasn't reacted how I thought it was going to react. And the obvious question to me is why? Why hasn't? Is it because of previous discounting? Now, let's just be very clear. I'm not suggesting that we go contrary. I'm saying we start talking about it until proven otherwise. Okay, because these interest rates here, they're not moving. So and then we had also the JOLTS report, the job openings yesterday, come out with much higher job openings than anticipated. No movement in rates. Isn't that something? No movement in rates. But if there's no movement in rates, okay, then are we sort of topping out here? And if we're topping out here, are we starting to build that base? Okay, so that's sort of the conversation. That's the conversation. Okay. Yeah. So Anna saying, but hang on a second. Powell made his hawkish position very clear. Agreed. I absolutely would agree with that, Anna. But what I'm suggesting is that the market is not acting on that, right? It's not acting on that. Yeah, so what we're saying is that there will be rates. There will be rates, but okay, and this is where we'll end off here, and then we're going to move. Then we're going to move to the next webinar. Of course, there's going to be hikes. Okay, that's not the discussion. See, that's not the discussion. Yes, there's going to be hikes. I'm not. That's not what I'm suggesting. What I'm suggesting is that those future hikes, Anna, have already been anticipated. They've already been priced in. Remember, markets are forward-looking. Now, I want to rephrase just this sentence very quickly. Okay? I don't want to say things that are not true. What I'm suggesting is, what I'm asking is, has the interest rate movements that we've seen already discounted all the price or the interest rate hikes. Because if it's already happened, okay, that means that the markets won't adjust as we approach the rate changes, because it's already discounted in. That's what discounting is. Okay, that's what discounting is. It's anticipating what's happening in the future. It's based on expectations and adjusting right now. So we're adjusting right now based on future expectations. Okay, based on future expectations. And then the question Anna asked, which I'm not going to answer here, I'm going to answer in the next webinar, but I'm going to state the question here, and then we'll go into the next webinar. Okay, is how many months ahead can the unknown be priced in? And I think that's an excellent question, and we'll end off here, and I will see you guys in the Crypto Minute in the next few minutes. Thanks very much, guys.